Hi, this is Steve Nison. Welcome to the next edition of Highlights. As you know, one of our major goals is help separating you from the competition. As a member of the CandleTrust.com family, we're here to help you harness the candles correctly. There's a lot of information out there, most of it unfortunately incorrect. Actually, fortunate for you, because by getting these highlights, we're going to make sure you're up to a correct knowledge level. And of course, we're not going to be able to relay all the knowledge in these short video clips, but want to make sure you're using the candles correctly. So that is truly an advantage to being part of our CandleCharts.com family. And with that idea of using candlesticks correctly, we're going to be looking at the hammer today. And many of you may be familiar with the hammer, but just to refresh your memory, the hammer is a bottom reversal signal. Okay, comes after a downtrend. And remember that phrase I just said, comes after a downtrend, because we're going to be discussing that in a few seconds. So, the hammer, very long lower shadow, twice the height of the real body. The real body can be black or white, and it's okay to have a little bit of an upper shadow. Now, the hammer, you can see by the shape of the line, it's potentially a positive signal with a long lower shadow. But what we're going to do now is making sure you're looking at the candlesticks correctly, especially the hammer. So with that in mind, let's look at the next slide. So here we have a hammer-shaped line. Very long lower shadow, small real body at the top end of the range. It's okay to have a little bit of an upper shadow. Okay, here we have another hammer-shaped line. Again, very long lower shadow and no upper shadow, white real body, so this would be a classic hammer. However, remember the phrase I said before, the hammer must come after a downtrend. And what did these two hammer-shaped lines follow? Actually, little uptrends. Not so little. So, indeed, these were not hammers. Okay? So, if you bought on this hammer, if you thought this was a hammer and you bought up here, you would have been buying it at exactly the wrong time. Again, as shown on the title of the slide, the importance of the correct knowledge. Now, for those a little bit more familiar with candles, we have something called the hanging man line. It's actually a hammer-shaped line that comes after an uptrend. But I don't really refer to them that much anymore. In my newest educational resources, I really focus on the most accurate and most important candlestick signals, and the hanging man line is not a really good line to follow, in my opinion. There's reasons behind it. I just don't have time to get into it here. But we're focusing on the hammer here. So these were not hammers. Okay. Now, the low in Google that we had back in mid-November, okay, that was a hammer. In fact, if the hammer line is a doji, you see there is no real body. There's a doji over here. Okay, that's actually called a gravestone, or I'm sorry, a Dragonfly Doji. And essentially, a Dragonfly Doji is where the open, high, and close are all near the highs of the session. So as the hammer gets a smaller and smaller real body, it could wind up being a Dragonfly Doji. And the reason it's called a Dragonfly Doji, here's a picture of a dragonfly. The Japanese have, so this would be like the Doji here. Okay, and the horizontal line represents the doji of the dragonfly. So the Japanese have really great picturesque expressions. So it was really not only was a challenge to uncover the candlestick secrets, but it was a lot of fun also because of the great terminology the Japanese use. But let's get back to this. So we have these as not hammers. Okay. This is a hammer over here. And one of the great things we could do with candlesticks is, for most of the candlestick signals, we could use them as support or resistance. So, for example, the low of the hammer here should be support, and notice how well that held in this particular stock. Now, also, getting, again, a little bit more advanced, since we're talking about the correct knowledge, notice what we have here in that red semicircle I just highlighted. I'll just make an arrow here. Okay, the black wrapping around the white. So that would be a bearish engulfing pattern. and but we would not be selling there, because if you knew the rest of the candlestick signals, you would know that at that arrow there, that red arrow that just emerged, it's a gap high, or the Japanese call a gap high or a rising window. And rising windows are support. So yes, you may have gotten a bearish candlestick signal, but you don't sell, because if you're selling it there, you're selling right near support. And I've seen traders lose big, big bucks by knowing just enough about the candlesticks to be dangerous, but not completely understanding how to use them correctly. So here, for example, somebody might know about the bearish engulfing pattern. They may say, hey, Steve says a bearish engulfing pattern is potentially a top reversal signal. That's true, but look at where you would have gotten the signal near a support area. Notice also how this rising window in the second arrow, and I'll draw it over here, became support. So windows are really good indicators. This actually was also a breakaway gap. Okay. By the way, the market can move under the window. You see, and let me clear all this gobbledygook away here. So I'm going to draw the window here. So the market could move under the window, as shown in this red line I'm drawing, but as long as it doesn't close into the window is still support. And the breakaway gap, this is a traditional Western tool. When the market gaps above a resistance area, that's a breakaway gap. And it's actually one of my favorite gapping techniques, because you've shown a real shift in psychology. What was prior resistance before, the market was able to push above it. And if you happen to be, here's another bearish engulfing pattern, if you happen to be negative or bearish in that bearish engulfing pattern, as soon as the market moved above this resistance line here, especially on the gap, you should be out of short positions. Remember, there's always a price that says we're wrong. That's what stops are all about. So, went through a lot of information here, kind of an overview of the hammer, the window, thinking about where the candlestick signal is. For example, we had the bearish engulfing pattern, but you wouldn't be selling it because it's near its support. The Dragonfly Doji, using lows of the hammer as support, and so forth. So I hope you found this useful, and may the candles continue lighting your path to greater profits.